So these are general administrative costs. These are management, finance, and other expenses related to the general management and administration of the business unit as a whole. To be considered a G&A expense of a business unit, expenditures must be incurred, allocated to the general business unit. So examples of these would be salaries and other costs of executive staff of the corporate or the home office, salaries and other such costs such as staff services as legal, accounting, public relations, financial offices, and sales and marketing expenses. So in small business, what we see commonly occur is that executive is also hands-on to that contract. So that's very, very common to have a president also hands-on in the performance of the contract. So in those cases, there may be, you need to have some type of record keeping if costs are going to be charged, split between that G&A pool and direct to that contract. So you would need to keep a timesheet to say, this many hours were direct to the contract, this many hours were G&A. And if there's an overhead rate, there might also be, some of those expenses may be in that, overhead rate if he, is directing engineering effort or, manufacturing effort or so forth. So it's important, especially in small business, to realize that not always do we see, executive compensation just going into the G&A pool. So allocation based. Indirect costs should be allocated based on benefits incurred to the intermediate and final cost objectives. So we always want to make sure that there has to be that relationship between the cost in the pool and the cost in what we call the base. So I think fringe is almost one of the easiest examples that people can relate to. Fringe cost is your insurance, it's your, you can put your FICA, the government, or your business side of your FICA, the business side of your Medicare. You have unemployment, all labor-related expenses, in that fringe pool. And then those would be allocated over what? What would be the most sense? What would make the most sense to allocate those costs over? They are incurred because you incur labor cost. So labor costs, labor hours, again, you have to make a decision what is best, what is the best base for your business setup. So, and then they use the cost, and they use the example of training. A lot of times there is a lot of required training as part of getting a government contract. There are some clauses that say that you will, provide annual training to all your employees for certain things. So that would make sense as something that would go, in the overhead pool, in the G&A pool.
Do you ever see a case where you charge training direct?
Oh, yeah.
To
Absolutely.
most of the time it's if the government or the customer requires that you have that training, then you can charge direct versus.
Yeah, I've seen training charged direct.
Sometimes
the
the
one thing
contract will actually state that. Other times it's silent to it, but sometimes if you question it, I've had instances where they will allow you to charge it direct to the
Just
contract.
ask the question.
Ask the question if you're unsure.
Right.
Absolutely.
I think an important aspect of that to remember is if there's multiple contracts that are involved that all have the same requirement, would also kind of play into, is it proper to charge it to one contract?
Right.
When multiple contracts are receiving the benefit.
Right.
So, but there's also contracts that, require specific training, related to a particular program or a particular facility, or, so there is instances where, training has been charged, I've seen training charged direct, have you had any experience?
Absolutely, it's driven by that causal beneficial relationship. If it's that particular procurement's requirement, then yes, it's a direct cost to the program.
Sometimes we need to get clarification from the PCO or the ACO to help us, you know, with
It's usually
that.
good
but-
when you have that, right, ask the question.
Yeah, just to clarify.
And we see a lot of that, a lot of times in records, we actually see you guys going out there and asking those PCOs and those ACOs, hey, I have this cost, you know, can I charge it direct? And, you know, there's nothing the auditor likes more is like, oh, they already thought about it and here's the answer. So, keep that
We
documentation.
love things in writing.
Yeah, keep the emails.
So, in general, typically allocation basis for overhead and G&A, maybe things like I've talked about so far is direct labor dollars, direct labor hours, direct materials. G&A, there's 3 different types of bases. The total cost input base, that would be all your direct and all your indirect costs minus your G&A costs, because those have to be in the pool. So those are what you're allocating out. And then a value-added base is the total cost input less subcontracts and direct material costs. And the reason why you may have a value-added base is you may look and say, if you include material and subcontracts in that base, it's gonna give an unfair allocation of those G&A costs to the contracts. So, I mean, that's always something to look at when you select that base. And then a single element base, maybe direct hours, direct labor dollars, which represents the total activity of the business unit used to allocate G&A expenses, and it produces equitable results. So a single element base may not produce equitable results when measuring activities, when measure where other measures of activity are also significant in relation to the total activity. So for instance, like it wouldn't necessarily be appropriate to use direct labor dollars if you had like a significant amount of overhead costs. Like in an overhead pool, so because those G&A dollars you're not considering those overhead costs, like that intermediate level in that allocation. So a single element base is inappropriate when where it is insignificant part of the total cost of some of the final cost objective. So again, you just have to look and say, these are the costs I incur, what is the appropriate base? So any questions on base, allocation basis?
I think there may be a little hesitation, confusion maybe about that single cost element base. Think of it as if you have those guys over there, they're all working off-site, and you guys are all working on-site, and we say there is no off-site overhead because they're on-site, there's no facilities costs, et cetera, they're all at the government facility, and then we've got these other contracts being performed in our facility, so we've got the rental costs, we've got all these other costs, and if we use a direct labor base, you know, these costs over here needed to be managed by someone, and by only using direct labor, we are in fact shifting the cost to those guys. So we want to make sure that there's that causal beneficial relationship, and does it make sense?
Any questions? Thank you, Martin. Allowability. A cost is allowable when a cost complies with the following requirements: reasonableness, applicable terms of the contract, applicable cost accounting standards. The small business is exempt from the CAS standard, so, I mean, unless you're growing at a rapid pace and you don't qualify for that small business exemption, you're not really gonna run into CAS all that much. And then any limitations set forth, and Part 31-201. So, and also, unallowable costs is also, or allowability. So FAR Part 31-205 defines select costs, which that says specific costs that are unallowable. And this covers everything from material cost, compensation for personal services, public relations, advertising costs. Again, that section 31-205 outlines those selected costs that are defined by the FAR as unallowable. So reasonable. So FAR considers a cost to be reasonable if in its nature and amount it does not exceed which would be incurred by the prudent business person in the conduct of competitive business. It is the contractor's responsibility to establish that each cost is reasonable. So, and this is an area where DCAA, the contractor, may differ on opinion when we look at something. So, but we're going to come to you and we're going to have a dialogue. We're just not going to be like, well, we don't think that's reasonable. You know, we're going to say we don't think it's reasonable, and you know, this is why. And then you know, have that dialogue of why it is a reasonable expense, why you do need to incur it, you know, in the nature of your business. So.
What kind of proof do you usually get to show something is reasonable? Or what do you usually see?
A lot of time it's the judgment and like what led you to the decision to make that purchase or to incur that cost. So let's take, for instance, if you, and I know this is an extreme example, but if you provided a car for every one of your employees. Put it in your overhead.
That sounds really good.
Sounds great.
Where's this company?
But the question would be, would a reasonable, prudent business person, you know, would they incur that cost? And by no means is DCAA saying that you can't, you know, you can't provide it, you can't pay for it, but, you know, we are saying that, you know, it's not a prudent expense that the government's gonna reimburse you for. So, you know, you can still, you know, purchase. Like a Jaguar or like a company car, like for the president, you know, that luxury vehicle. You know, and that's fairly common is, you know, there might be costs of a vehicle in there. Well, you know, it's gonna be limited to that cost of, you know, what is, you know, that luxury, you know, you have luxury and then you have like a standard car. So, you know, we may question the difference on that reasonableness, like it wasn't reasonable for you to incur that expense. Martin, did you have something to add?
I think a common area where we see reasonableness in dialogue is related to compensation. Let's face it, you know, a lot of times small businesses, they're growing, they're a very niche market or niche technical type of engineering or whatever it may be. So you as a contractor may say, well, I believe our president or our engineers should be being paid $75, $80, $90, $100 an hour. And it's like, how do you demonstrate that that's a reasonable cost? There are salary surveys out there. You may have looked at 2 salary surveys, salary.com and something else. And DCA has some established parameters in how we're able to use salary surveys. So that might be a situation where we have one perspective and we're going to ask you, what do you have that supports why you believe the cost is reasonable? And it's a dialogue and then we work through it.
And another place where we run into this a lot in the proposal environment is escalation factors. So when you're trying to determine what your costs are going to be for those out years on that contract. So we're going to, you know, say you're proposing an escalation of 10%. You know, we subscribe to indices that, you know, we go out, we utilize, but we also will, you know, we evaluate what is your support behind that 10%. You know, what did you use to come up with that 10%? we're not automatically gonna turn to, you know, the subscription that DCAA, you know, subscribes to and say, well, Global Insight says 3%, so, you know, we're gonna use, you know, 3% in our evaluation. We're gonna come to you and say, okay, how did you arrive at 10%, and what is your support for that 10%? So escalation and in the proposal environment is where I see a lot of times that we're questioning based on reasonableness. You know, because we're gonna look, say, what have you historically experienced? You know, if you have some history of where you've purchased that material for the last 3 or 4 years, we're gonna say, you know, historically, we see your escalation, you know, being at 4%, you know, what changed to make it now 10? And there is obviously situations that occur that make 10% an absolute reasonable amount of escalation. But, you know, we need to see that support and that, you know, that judgment and that rationale to how you arose with that decision. So, does that make sense? Questions?
Yeah, and I know you're not a CO, but I always find it interesting. A lot of times they'll predefine what that escalation is by the years in a lot of solicitations. But sometimes they don't. They say no escalation. And you kind of look at that and you're like, well, you know there's inflation or there's other factors that it raises or anything like that. But yet they'll release a proposal that says no escalation in the out years. So I guess that what they're really looking for contractors to do are basically place that into your final price somehow, that if you're gonna do raises or anything like that the escalation is built in. I was curious if you had any thoughts on that as far as why would you release a solicitation that doesn't have an escalation on it if it's a 5-year contract in each of the years? Because I've seen stuff like that.
Are you able to tell me what type of contract it was? Because there are
Cost
some.
plus.
Okay, cost plus, but was it of were the product or service being acquired covered by like Department of Labor wages, such that there's a wage determination that exists? And so there is a defined wage that's the base wage that all the bidders are going to put in that contract and apply. And so whenever the wage determination changes, generally there's a contract clause that says because of that change in the wage rates, we then have an equitable adjustment, and so that the contract is modded to account for the escalation as it has changed.
Yeah, I don't know, it's a lot more detailed than I thought, that I've looked into, but what you're basically saying is that there might be a clause there to mod the contract later, even though there's not an escalation, you know, they could mod it later to allow for that.
It depends upon the nuance of the contract. You know, I have not seen a contract where you as a contractor would be manufacturing widgets, that there would be a clause that says no escalation. Okay, I wouldn't see that in a solicitation. But if I saw a contract that was based upon Department of Labor wage determination, yes, I'll see them cap it, because there's this understanding in that particular nuance type contract, certain things are going to happen through the life of the contract.
Or
I'll have to
also,
look for that.
if it's type like a GSA type schedule.
You don't see it very often, what you're saying, but.
Yeah, but your GSA schedules are usually escalated.
Right.
They should be.
Yes,
Look for the Service Contract Act. Is it for services?
Yeah, it is.
Yeah, look for the Service Contract Act, but I have seen proposals that, RFPs that have come out where there's no escalation. I don't know if they just have a not to exceed and they can't go over a certain amount,
Yeah.
you know, and that you just gotta stay. It sucks,
That's what this one
but
is.
that's, it happens. I've seen it.
Air Force BPA something.
Oh, yeah. Oh, yeah.
You're
I've
familiar
seen
with
it.
that one?
Yeah.
It does have escalation.
Yeah.
Okay.
It happens.
Yeah.
You just gotta deal with it. Or don't bid it. I'm just saying.
I think she's trying to get her part of the market.
It's
Just
okay.
saying.
Of course. Okay.
So allowability, the cost is allowable to the government contract if it's incurred specifically for the contract. So obviously, you know, if you need labor to, you know, meet the requirements of the contract to complete that scope of work, or materials, or travel, or other direct costs, you know, that's costs that can be incurred specifically for the contract. but or that it benefits both the contract and other work, and can be distributed to them reasonably proportionate to the benefit received. So again, like fringe, rent, if multiple contracts, or, both government and commercial work, receive that benefit, and it's distributed, again, that reasonable, in a reasonable proportion to the benefits received. Those are allowable costs, and it's necessary to the overall operation of the business, although a direct relationship to any particular cost can't be shown. So, like you have an accountant, that you get assistance from, you have legal fees, like for the overall operation of the business, there's all kinds of, there's general administrative, that indirect labor aspect, that executive, that secretary. It's not, the contract directly isn't benefit from it, but it's needed. It's there, it's needed to conduct your business. So some questions to consider is, that you would want to consider is, was it incurred for a single cost objective? So was it incurred directly for this contract? So that's, the first question that you ask yourself. So if that answer is yes, then, it benefits the specific contract. So if the answer is no, then you have to say, well, what does benefit from it? Or if it wasn't incurred directly for the contract, why was it incurred? And so then it must be allocated to the benefiting, cost objective. So the labor cost, or, all of this, like total cost input, basis. Are the costs that benefit the contract and other work allocated in reasonable proportions to the benefit received? So if the answer is yes, the cost does benefit the contract and other work, the cost must be equitably allocated to all the benefiting cost objectives. So an example of this is, company allocates cost of a technical word processing department by dividing the department's operating cost by the number of pages produced during the year, and then charges each cost objective based on the number of pages produced to support the objective. So, they have a technical publications division, they print millions of pages each year. All the cost for that department are then charged to say, okay, how many pages were allocated to this department and to that department. So again, it's that, who's receiving the benefit of that cost incurred. If the answer is no, then it probably goes into that third category, is it required for the overall operation of the business? So for an example, a company proposes to charge the salary of the chief executive officer secretary to all operations because the secretary is necessary for the operation of the firm. There appears to be a proper cost allocation, even though the secretary's activities may not benefit any particular product. They do, however, support the overall operation of the firm. You guys know, secretary runs the place. Nothing gets by the secretary. So that's the way I always look at it, because they know who's coming in and who's going out. They know where everybody's at. So I always used to have a joke, because I used to be a secretary. I used to say, I'm going to go on vacation. Well, what are we going to do? So, and we have admin staff, and many times it's just like when I was in European branch office, we had our admin staff, and we just said, well, she knows what's going on. She knows how we're going to get our reports issued. So, just a little joke. Contract terms. So sometimes there are specific contract terms which we talked about before with the no escalation in the contract or the request for proposal. So however, contract terms can only be more restrictive than other factors and must be considered in determining cost allowability, not less. So in other words, a a contract term cannot allow a cost that's unreasonable, improperly measured, assigned and allocated to the contract, and unallowable in accordance with the specific cost principles. So a contract term, couldn't allow something that FAR Part 31-205 says is unallowable. They couldn't, they can limit the G&A, like they could set a G&A rate, but it usually says is, X percentage or their actual G&A rate. So, a lot of times, what I've seen recently is that, contracts have said that, like, they are not allowing G&A on material costs is something I've seen recently. Have you seen any specific contract terms related to limitation of cost recently?
The G&A limitation, that's it.
Overtime is another one that's pretty common. It'll specifically say how much overtime is available or allowable. So, and I mean, I've worked with a contract for years actually, where that was modded several times. Each month it was monitored, and it was modded to increase that overtime based upon the requirements of the contract. So the accounting system must be able to accumulate and report costs for each final cost objective. For instance, government contract or commercial contract. So, it must accumulate costs for all contracts, just not government contracts. So it needs to, all the business operations need to be accumulated. Direct cost of the contract plus applicable application of indirect costs, and of course, less unallowable cost. So, any questions on that? So accounting for contract costs, DFAR 252-242-7006C requires the accumulation of cost under general ledger control, requires that the reconciliation of subsidiary ledgers and job cost ledgers to the general ledger, requires the approval and documentation of adjusting journal entries, and requires that at least on a monthly basis, the determination of cost charged to a contract through routine posting of the books and records. So I wanted to see if this, I just want to go into a little bit more detail under these. So you have to have that general ledger set up as part of your accounting system, so that logical grouping and categorizing and reporting of expenses. And the reconciliation of subsidiary cost ledgers to the general ledger. So let's say that you have in your general ledger, you have a labor account, but you might have an Excel spreadsheet that breaks down all your labor. So if that general ledger account says $100,000, that Excel spreadsheet that breaks down all the labor should reconcile, so that should be $100,000 also. Approval and documentation of adjusting journal entries. So if changes are made, after you post to the general ledger, after you say these are the costs that we incurred, and then you look at it and you say, oh, I accidentally improperly classified something. You make an adjusting journal entry, that approval and documentation of that adjusting journal entry. Usually it's, by some type of accounting manager or president, whatever, again, however you set your business up, but there should be that process and that documentation as to why was that adjusting journal entry necessary and why was it made. And then, again, at least on a monthly basis, you should be recording your cost, looking at those costs, and posting to the books, posting of books of accounts. So posting, making sure that your records are up to date, at least on a monthly basis. So, the labor system, again, the labor system's it's part of the accounting system. So DFARS requires that a timekeeping system identify employees' labor by intermediate or final cost objectives. So kind of the example that I gave, if the president of the company is also working direct on the contract, so his timesheet would have, G&A, whatever the G&A code is, and then it would have a line for, direct to the contract. Labor distribution system that charges direct and indirect labor to the appropriate cost objective. So again, that accumulation of that labor showing to where it goes to that, to that contract cost as direct, or to that overhead cost, or to that overhead pool, or to that G&A pool. So questions about that? I know Robin's gonna talk a little bit about floor checks. Or I'm sorry, what do we call it now, real-time labor testing.
I'll call them floor checks. I'm old school.
So timekeeping, a few things to remember about timekeeping is that, it should be charged to intermediate final cost objectives. The timekeeping documents can be paper or electronic, but it's important to remember that there should be controls on the access to the timekeeping, to the timesheets. So, if it's like timesheets, they shouldn't just be out in a stack over here. They should be a controlled document or have a system that has access, username, pins, and so forth. It needs to provide an audit trail, of changes made to the timesheets. Employees should fill their timesheets out on a daily basis and include all hours worked, included uncompensated overtime. So, if you're, if you have a salaried person, their salary is based on 2080, they still are required to record all those hours worked. Just not, just not like a standard 8 hours. Remember that policies, I'm sorry, I already said that one, approved by the supervisor is also an important part of that. So remember that there are separate accounts for government or commercial contracts, so you should have an account set up for that final cost objective, whether it's that government contract, it's that commercial contract, it's that overhead pool, that G&A pool. And also, have them set up for like holiday labor and sick labor, so you're tracking all those costs to make sure they get into that correct account. And there should also be a separate account set up for bid and proposal. And be sure to display the DoD hotline posters in common working areas if a contract contains the DFARS clause 252-203-7002. So you just have to look to see, if that clause is included in your contract. There's some dollar thresholds and so forth associated with that clause. Any questions on our labor costs should be reconciled to the payroll records and labor distributions and traced to and from the job cost ledger and the general ledger of account. So again, like I said, that subsidiary ledger always needs to tie back to the job cost ledger, and that should also tie to the payroll record. So like if you have an outside service, those hours, should tie. Obviously, those uncompensated hours will be booked differently on a timesheet. Unallowable cost. So FAR 31-201-6 requires unallowable costs, including directly associated costs, to be excluded from any billing, claim, or proposal applicable to government contracts. FAR 31-205 explains allowability of specific cost elements. So there is, FAR does define some specifics as it relates to allowability. The contractor needs to have a written policy and procedure on how to identify and exclude unallowable costs. And unallowable costs need to be identified, like I said, and excluded from claims, proposals, and government contracts. So some of the expenses that you may commonly incur but are unallowable are interest expenses, entertainment costs such as holiday parties, company picnics, etc. Key man life insurance, advertising costs, contributions, donations, and like certain legal costs like for acquisitions or mergers or so forth. So it's an important part of the FAR to kind of become familiar with. Because even when I started, I realized, when I started my career way back 2002, before that I worked at a tax firm and I was like, and did taxes, and I was like, wow, it can be written off on taxes, but it's not always an allowable cost for government contracting. So there is a difference. So cost by contract line item. So we're actually experiencing a lot more of this. So the DFARS requires that identification of cost by contract line item and by units as if each unit or line item were a separate contract if required by the contract. So the accounting system needs to be able to set up at that lower level of the contract. We're seeing more of this where we have a contract that we have a CLIN structure that where labor is maybe on one CLIN, and material may be on another CLIN, and we're also seeing it broken out by years. So it's very important that your system can break it down at that particular level. And we actually recently sent out a letter to all of our contractors under our cognizance, kind of explaining this requirement. As we go through this series, we'll talk about incurred costs, but it's very important that, because we look at that when we review public vouchers. And we look to say, does the contract exceed, the funding limitation? So it's very important that if the contract requires that your system can track the cost at that level. And it's something that I have to say in the last few years has become more and more frequent than before. We didn't see a lot of cost broken, or contracts where the had multiple CLINs and funding limitations and contract value by CLINs. So, and then make sure that the contract is adequately briefed to determine what that level might be. So go through, read your contract, brief your contract, make sure you understand. If you have questions on those, contact your PCO, contact your ACO. You can, if you're interacting with us, you can give us a call, and we can look at it, and, usually we get the ACO involved. But so like I said, it's becoming more and more common that I've seen in the past few years. Billings, interim billings, progress payments, or public vouchers. Well, that was like a good lead-in, and I didn't even realize I did it. Or direct costs need to be prepared directly from the books and records, and again, excluding unallowable costs. Procedures to ensure that subcontractors and vendors' costs are only included in the billing if the payment to those subcontractors or vendors will be made in accordance with the terms of the contract or invoice, and normally within 30 days of when the contractor requests payment from the government. So you need to make sure that if you're including those subcontractor billings, vendor billings in your invoice, that you're paying your vendors, your subcontractors in a timely manner. Some other items about billing is FAR 52-216-7, allowable cost and payment clause. Recorded costs that have been paid by cash, check, or other forms of accurate payment for items or services purchased directly for the contract. When a contractor is not delinquent in paying costs of contract performance in ordinary course of business, costs incurred but not ordinarily paid for supplies, services purchased directly for the contract and associated financing payments to subcontractors, provide payment and payment determination be made, again, in accordance with the terms of the contract or ordinary within 30 days. So this just goes over that, gives the detail behind that requirement to pay those suppliers and those vendors. Billings need to be based on current contract provisions. The total amount billed should not exceed any contract, work order, funding limitation, or other contract ceiling limit. So you need to make sure your system is set up to define, capture and recognize when you may be close to that ceiling or when you've gone over that ceiling, to make sure that you don't exceed the funding limit, whether that's at the work order level or, at the contract level. And so it's important to brief the contracts to identify those provisions, but this is limited to restrictions on the frequency of billing. Usually the contract will say how often you can bill on a government contract. Special withholding provisions, there's a provision to withhold fee, up to 85% of the fee, and talk with the ACO and say, does that 15% withhold need to be, by each voucher, or can you arrive at that 85% fee and then stop billing fee after that point? Contractual unallowable cost. Again, there might be a limitation on the G&A for a particular cost element or overtime.
Is there, the billing frequency here, is that something that's part of the negotiation before the contract's awarded, or is that, does the government stipulate that and say, we want you to bill twice a month, or?
Usually what I see is twice a month, but I would think that it would be something that could be negotiated, but usually what I see is twice a month, or monthly. So, but I think that would be a question. I can't say that it's not up to negotiation. I think that would be something that you probably want to talk to the PCO about. It's kind of out of my realm. I just go read the contract and see, okay, it is twice a month.
I've never
But
seen it in there, that's why I asked,
It's,
so.
you've never,
You've never seen it in there, is that what you said?
Well, I've not specifically seen the billing frequency, but I've never looked for it because I never knew that it was gonna be in there.
I think currently the standard, what we're seeing in many cases is not more frequently than every 2 weeks. And generally, there is some contract verbiage that explicitly states that. So if you're looking at a solicitation and it's talking about particular clauses that may be in the subsequent contract, you might be looking for those clauses addressing billing and look at that and see what type of descriptive direction is being provided.
Okay,
Yeah, and I'm pretty sure that FAR clause that you referenced speaks to that.
does it?
I'm thinking it does too, but I
I'm
didn't
pretty
like-
sure, but I haven't read it in a while, but read it, because I think that FAR 52, was it 216?
allowable costs and payment.
Yeah, I'm pretty sure it speaks to